Western Visayas is currently the fastest growing regional economy in the Philippines, posting a 6.4% expansion that outpaces the national average. This growth is largely driven by corporate decentralization. Companies are looking beyond Metro Manila, pulling a wave of highly skilled talent and business tourism directly into hubs like Iloilo City. At the center of this demand is Megaworld's 72-hectare Iloilo Business Park. It holds nearly half of the local office market, alongside an integrated ecosystem of residential towers and high-end hotels. This setup creates a trap for out-of-town investors. Seeing the cranes and the foot traffic, they often assume that buying any property inside the township will deliver identical financial results. In reality, the market forces you to choose between two completely different legal and operational structures: a conventional residential condominium or a branded Condotel asset. Treating these two assets as interchangeable is dangerous. Pick the wrong one, and you could end up with a high-maintenance headache instead of passive income, or an illiquid trap when you needed a quick exit. Let's define exactly what we're comparing. Our first contender is the conventional Megaworld condominium, specifically projects like St. Honoré or the Pinnacle. These are standard, titled residential units. As the owner, you have complete legal and physical autonomy over the space, to live in it, lease it out, or renovate it as you see fit. The second contender is the branded Condotel, represented here by the newly launched Belmont Hotel Iloilo. Under this model, you purchase a titled hotel suite. However, upon turnover, you enter a mandatory leaseback agreement. The hotel operator takes control of the unit and runs it as a commercial lodging space. With a condo, you are buying a private dwelling that requires active effort to generate rent. With a Condotel, you are buying a financial participation product tied directly to the hotel's operating performance. Finding the better investment here has very little to do with developer projected ROI percentages. It comes down to a strict matching of your personal capital, your available time, and your exit timeline. The first constraint is the most obvious: the cost of entry. This table outlines current project pricing. Conventional condo units offer an accessible entry point for early-stage investors. You can acquire a studio at St. Honoré starting around 4.8 million pesos, with other options stretching up to 8.9 million. Because these are standard residential titles, they benefit from highly transparent bank financing pathways. You can secure standard home loan interest rates and favorable loan-to-value ratios. Now look at the Belmont Hotel unit types. A Condotel demands a massive price premium. The entry-level twin suite starts at over 10.15 million pesos, roughly double to triple the cost of a standard residential studio. That higher price tag comes with financing friction. Condotels are classified as commercial properties. Banks are historically reluctant to finance them, which usually results in higher interest rates and stricter lending criteria. This acts as a hard filter for your portfolio. If your available budget is strictly below 10 million pesos, the Condotel market is mathematically closed to you. If you have the capital for either option, the next filter is operations. We'll start with the conventional condo landlord experience. As a condo owner, you carry 100% of the vacancy risk. If your specific unit sits empty, your monthly yield is zero. You are fully responsible for finding tenants, handling late-night repairs, and paying the monthly association dues. The upside of carrying that risk is absolute control. You can sign stable, long-term corporate leases, or pivot to lucrative short-term Airbnb rentals during high-demand events like the Dine Festival to maximize your returns. The Condotel model operates on a pooled revenue system, which entirely eliminates individual unit vacancy risk. Under this structure, every owner receives a share of the entire hotel's profit based on their unit size, regardless of whether their specific room was booked. But this convenience comes at a heavy cost. The operator deducts massive fees, often 40 to 55%, along with booking commissions and furniture reserves. These deductions severely dilute the top-line revenue. What actually reaches the investor's bank account is the much smaller net distributable yield. To achieve that truly hands-free income, you must surrender all operational control. Megaworld Hotels sets the nightly rates, chooses the marketing strategy, and handles the guests. You have zero say in how your asset is priced. Maximum yield requires your uncompensated time and labor. True passive convenience requires surrendering a massive cut of your gross revenue. To soften the blow of those management fees, developers sell Condotels with a unique lifestyle perk: Owners receive 30 complimentary room nights every year. This guarantees you a high-end, maintenance-free vacation home for annual visits to Iloilo without having to clean it before you leave. The restriction is that you cannot live in your Condotel full-time. Conventional condo owners have unlimited personal use of their units, but they are entirely responsible for furnishing and maintaining the space. But the most critical factor investors overlook is exit liquidity. What happens when you decide it's time to sell? This comparison table shows a stark contrast. Conventional condos have a massive, broad secondary market. When you list it, your potential buyers include other investors, expats, and local families looking for a primary residence. Exiting a condotel is drastically harder. You are selling a purely financial product to a narrow, investor-only buyer pool. Because the unit is locked into a hotel contract, a family cannot buy it to live in. This often creates severe resale friction. If you anticipate needing to liquidate your asset within 5 to 10 years, a conventional condo offers a far safer exit strategy. Condotels require a strict commitment of 10 years or more. To eliminate the guesswork, we can map your personal situation directly to the right asset using a simple decision framework. We start with the capital constraint. Is your budget strictly under 10 million pesos? If the answer is yes, or if you require standard residential bank financing, the math makes the decision for you. You are buying a conventional condo. If you have the capital for either option, we move to physical proximity. Are you an overseas Filipino worker or highly time poor? If you cannot handle midnight maintenance emergencies, manage tenant turnover, or coordinate repairs from Dubai, the Condotel is built for you. You pay a premium for total passive operation. For those who do have the time to manage property, the final filter is your investment duration. Is your horizon less than 5 to 10 years? Short-term players who need exit liquidity must choose the condo. Long-term players seeking exposure to the hospitality sector without running a hotel can opt for the Condotel. Your physical location, your free time, and your exit timeline dictate your real estate choice far more than any developer's projected yields. Before you sign any reservation papers, execute proper due diligence. For condo buyers, review the master deed to verify the rules on short-term leasing and account for association dues in your yield calculations. For condotel buyers, the warnings are more severe. Do not accept marketing brochures as proof of income. Demand to see the actual audited distribution history from the operator's other properties. Ask for the exact profit-sharing waterfall and the rules on furniture reserve deductions. Condotels behave less like simple real estate and more like SEC-regulated investment contracts. They require intense legal scrutiny before you hand over your capital. Both Megaworld condominiums and Belmont Hotel units allow you to capitalize on the undeniable economic boom happening in Iloilo. True investment success just comes down to buying the operational structure that matches your reality.